I don't like making this video, but the warning signs flashing across the US economy right now demand your attention because the short term pain that's coming is the exact thing that makes the long term opportunity in XRP and you cannot afford to miss. XRP Army. Let me be direct with you tonight. I generally do not like making videos like this one, but there are some undeniable warning signs currently being presented inside the US economy and the broader world economy that demand your attention. And that is exactly why I'm doing this. I'm giving you the information you need to hear, not the information you maybe want to hear. But I want to make something very clear right at the start. The long-term prospects for XRP and its price action have not changed. The long-term valuation for XRP and its growth thesis, nothing has changed there. What has changed are the short-term negative catalysts. And those catalysts are presenting what I genuinely believe is one of the best discount opportunities to accumulate XRP in this entire cycle. Tonight, I'm going to walk you through exactly what is happening, why XRP has been trading down, why we've been seeing major corrections across the crypto market, and what every patient holder needs to understand about the next few months before the structural setup completes. But this is the part almost nobody understands. Let's start with CPI inflation, because this is one of the leading indicators for where we are going next on risk on assets like cryptocurrency. The data is telling us something the financial media is downplaying. US CPI inflation is on track to exceed 5% as early as this year. Over the last 6 months, CPI inflation has averaged 0.4% on a month-over-month basis, with March and April readings running as high as 0.9% and 0.6% respectively. If this trend continues, year-over-year inflation is on pace to surge to 5.2% by September. Now look at the historical chart and tell me what you see. Right before 2021, we had extremely low inflation numbers. It was near zero in 2020, and then quantitative easing began. The CPI inflation absolutely exploded into numbers that were not sustainable. The Federal Reserve responded with quantitative tightening. Inflation came back down. And now, we are watching the same pattern set up again. Inflation is breaking back above the key level. The trajectory is pointing toward 5%. And what this looks like to me is the Federal Reserve being forced, maybe in just a few months, to look at quantitative tightening for a second time in the same cycle. And this is where the story becomes dangerous. I don't need to remind you what happened the last time quantitative tightening took place. It produced major corrections across the entire crypto market. The question now is not whether the same dynamic plays out. The question is exactly how and when. Are we going to get a strong rally for the next few months while inflation is still rising? Will the Fed cut rates even with inflation elevated? Or will they hold and then pivot harder when the data forces their hand? What does the timeline actually look like in front of us? When you look at Kevin Walsh, the new Fed chair, by the way, his messaging is already starting to shift toward potentially cutting rates. And we know the market reacts aggressively to rate cuts. We saw exactly that in 2022. But the complication is that the inflation we're seeing right now is not the same kind of inflation the Fed knows how to fix with policy alone. It's being driven by rising oil prices and rising commodity prices, which are flowing through into higher transportation and fuel costs across the entire economy. That kind of inflation does not respond to rate cuts. It responds to supply-side resolution. And the supply-side resolution requires geopolitical conditions that are not yet in place. Now, here's where things get serious. Now, let me show you something that almost nobody in the XRP space connects properly. Hedge funds are extremely exposed right now to semiconductors. And you might be wondering, how would that impact XRP? Semiconductors, chips, crypto, they are not directly integrated, but the connection is much closer than it looks on the surface. Bitcoin mining involves massive computer infrastructure. computers built on semiconductor chips, validators running on hardware that depends on the chip supply chain. This is core to how crypto actually operates at the network layer. When semiconductors are sitting in a massive bubble like they are right now, it becomes cost prohibitive for miners to invest in new infrastructure. Fewer miners, less efficient networks, Bitcoin price under pressure. And whether you like it or not, XRP has not decoupled from Bitcoin yet. When Bitcoin goes down, the rest of the crypto market follows. That is the market structure we are operating in. It does not match the long-term thesis. But in the short term, it is the reality. What I imagine eventually happening is a meaningful unwind in semiconductor exposure. Some analysts believe there's a bubble forming there. If it pops, it could actually be a net positive for crypto over time, as institutional capital reallocates. But that's going to take time to play out. We are not at that point yet. We are at the point where the bubble is still inflating, and the risk that comes with it is still concentrating. And what happens next changes everything. Now let me show you what is, in my view, the single most important institutional signal flashing in the market right now. Berkshire Hathaway, Warren Buffett's company, currently sitting on an all-time high of $397 billion in cash. Let that number sit with you for a second. 397 billion is enough cash to buy 478 different companies inside the S&P 500. That is the scale of dry powder one company is currently holding. And when you look at the historical chart of Berkshire Hathaway's cash position, the pattern becomes impossible to ignore. Every single period of financial crisis correlates with Berkshire Hathaway increasing their cash holdings significantly. You can see it happening right before the 2008 financial crisis. Cash piled up, stocks corrected. Berkshire loaded up at the bottom. You can see it happening again right before the pandemic in 2020. Cash piled up, stocks corrected. Berkshire bought in. And now we are watching the same pattern set up for a third time. The cash position is unbelievably high. The market is at elevated valuations. And the institutional behavior of one of the most successful capital allocators in financial history is telling you what their internal models are saying about what comes next. Because once you understand what Berkshire Hathaway is doing with $397 billion in cash, you realize the smartest money on earth is preparing for something the retail crowd hasn't even started watching for. But this is the part almost nobody is internalizing. A correction is coming. I'm not saying tomorrow. I'm not saying next week. I'm saying the structural setup is in place and the historical precedent is overwhelming. We have been in this trend for months. Trading at insane premiums on semiconductors, AI, and technology stocks. The correction is overdue in my honest assessment. This does not mean we cannot have another few crazy months. That is entirely possible. Honestly, it is even likely that the next couple of months for technology stocks will be wild, which also creates some short-term upside potential for crypto. But the broader risk is leaning in the wrong direction. And that is exactly why Berkshire Hathaway is sitting on the largest cash position in their history. Now let me show you the deeper reason behind why Berkshire is sitting on this kind of cash. The stock market is overvalued on price-to-earnings ratios, and bond yields are spiking higher globally. Look at the numbers: Japan, the US, Canada, Europe, the UK. Every major economy is seeing rising yields simultaneously. It actually makes more sense right now to sit in cash and bonds than in equities or crypto. You can see there is a bubble forming. You can earn meaningful yield on bonds. And the institutional move of stepping into cash is a direct response to that calculation. The British 10-year yield is at extraordinary levels. The US is elevated. Canada is elevated. Investors are taking advantage of the yield environment. And that is pulling capital out of risk assets. Now here's where things get serious for the contagion risk. But there is a second-order effect that almost nobody is connecting properly. Rising bond yields do not just pull capital out of risk assets. They create a contagion risk for the entire US economy, higher borrowing costs for governments, higher borrowing costs for businesses, higher borrowing costs for households. All of that translates into less available capital across the entire system. Mortgage rates go up, business loans go up, auto loans go up, credit card rates go up, corporate bond yields rise. Profitability comes under pressure. Investment slows, consumer spending curbs, the housing market gets squeezed. Mortgage rates often rise in tandem with treasury yields, which reduces affordability and cools demand for homes. The cooling housing market reduces wealth effects. The reduced wealth effects further compress consumer spending. The compressed consumer spending feeds back into reduced corporate revenues, and the whole system tightens. What I'm describing is the mechanism by which rising bond yields eventually produce major corrections in equity and crypto markets. The average investor and the average company simply do not have the expendable capital they had 6 months ago. And historically, every single time we have seen this dynamic, it has produced downward pressure on risk assets like crypto and tech stocks. That is why Berkshire is sitting on $397 billion in cash. It is not pessimism. It is preparation. And this is where the story becomes dangerous to ignore. Now layer in the obvious catalyst that everyone is watching but very few are properly pricing. The Middle East. Iran has updated a proposal for a deal to end the conflict. The White House has rejected the deal as insufficient. We are getting more stalling. And more stalling means higher oil prices for longer. A blockade that has not changed. Oil markets that remain elevated. Energy costs that flow through into transportation, manufacturing, and consumer prices. An inflation that stays sticky because the supply-side conditions producing it are not resolving on any near-term timeline. This is the macro background against which the Federal Reserve is being asked to navigate. They cannot cut rates aggressively because inflation is rising. They cannot raise rates aggressively because the bond market is already strained and the economy is already absorbing the impact of elevated borrowing costs. They are caught between two pressures with limited room to maneuver. And in the middle of that pressure, retail XRP holders are watching the chart move sideways or down and wondering what is wrong with the thesis. The answer is nothing is wrong with the thesis. The macro conditions are simply not the conditions in which risk-on assets rally. They are the conditions in which risk-on assets compress, while the smart money positions for the next phase of the cycle. Now here's where things get serious for the timeline. Really, in the end, we are in a waiting game. We are waiting for yields to come down. We are waiting to see what Kevin Walsh signals at the next Fed meeting. Is he positioning to cut? Is he going to hold the line? Is the messaging going to shift if inflation prints come in hotter than expected? We are watching Berkshire Hathaway's cash pile. Is Buffett going to start dwindling that pile and stepping back into the market? That would be the signal that the institutional view of the correction is moving from coming to here. Stock markets are going to start deflating eventually. The question is timing. And the answer is going to come into view very soon, within the next few months, in my view. What am I personally watching on XRP specifically? I genuinely believe XRP is the most reactive risk-on asset in the market right now. That makes it a really strong leading indicator for where the broader market is headed. If XRP is showing weakness, if it is trading down on news that should be bullish, it is a strong indication that the available capital in the markets is being constrained. Hedge funds are not deploying meaningfully into crypto right now. If they were, prices would be much higher than they are. The hedge fund capital is concentrated in semiconductors. And semiconductors are the most exposed sector to the contagion risks I've been describing. When that exposure unwinds, and it will eventually unwind, the capital has to go somewhere. And the asset classes that benefit from that reallocation include the assets that have been suppressed during the high-yield, high-bubble environment. And what happens next changes everything for the patient holder. Here is what I want every XRP holder to understand. None of what I have just walked you through changes the long-term thesis. The Clarity Act is still advancing through the Senate. The institutional infrastructure for XRP, Project ION, the DTCC partnership, the Fed Master Account application, the OCC Trust Bank Charter, the global regulatory positioning Ripple has built in the UK, the EU, and Asia. None of that has been disrupted by what is happening in the macro environment right now. What the macro environment is doing is creating the entry conditions that the institutional players have been positioning for. Berkshire is in cash because they expect a correction. The hedge funds are concentrated in semiconductors because that is where the marginal returns have been. The bond market is offering yield because the central banks have been forced to keep rates elevated against a backdrop of stubborn inflation. All of those conditions are temporary. Inflation cycles end, bubbles deflate, cash gets deployed, yields normalize. And when those conditions resolve, the capital that has been sitting in cash and bonds and overvalued semiconductors needs to find a new home. The home it finds is risk-on assets with structural catalysts, which is exactly what XRP is sitting on right now with the Clarity Act in markup. But this is the part almost nobody's connecting. The patient holder who is watching XRP trade down in this environment is not watching the thesis fail. They are watching the entry price be temporarily delivered by macro conditions that the institutional players knew would arrive. The institutions that have been building positions through the suppression, the whale accumulation, the ETF custody growth, the OTC absorption, are buying through this exact period. They are not waiting for the macro environment to be perfectly clear. They are positioned for the asymmetric setup that follows a correction. That is what the historical pattern shows. That is what Berkshire's $397 billion in cash is telling you about the broader cycle. Cash gets deployed at the bottom, not at the top. The top is when the cash piles up. The bottom is when the cash starts moving back into assets. And this is where the story becomes dangerous to misread. The question for you as a retail holder is not whether the correction comes. The data is telling you the macro setup favors it. The question is what you do with the period before the correction completes. If you're sitting in cash waiting for the perfect entry, you're competing with Berkshire Hathaway for the same entry. They have $397 billion, you do not. If you're already positioned in XRP and you're watching it trade sideways or down, the question is whether the conditions that made you buy in the first place have changed. The institutional infrastructure, the legislative trajectory, the supply compression, the whale accumulation, the macro alignment with neutral settlement assets. The answer is no. None of those conditions have changed. What has changed is the short-term price action. And short-term price action does not invalidate long-term theses. It tests the patience of the holders who do not understand what they are holding. The retail community gets shaken out by short-term price action because they do not have a framework for understanding why the price is doing what it is doing. The patient holder has the framework. And the framework tells them that the macro conditions producing the current weakness are the same macro conditions that will eventually produce the unwind that delivers the next leg of the cycle. Now here's where things get serious for your positioning. Here is my advice for navigating the next few months. Do not panic, sell into the correction. Do not chase rallies that fade before they confirm. Continue dollar cost averaging if that is your strategy. Position size appropriately for the volatility we are likely to see between now and the resolution of the macro pressures I have walked you through tonight. The catalysts that move XRP higher still ahead of us. The Senate floor vote on the Clarity Act. The presidential signature targeted for July 4th. The 90-day operational window that opens after signature. The Fed master account decision for Ripple. The OCC stablecoin framework. The DTCC's October full-service launch on tokenized rails. The institutional partnership announcements that follow Clarity Act passage. Every one of those events is unaffected by CPI inflation. Every one of those events is unaffected by semiconductor exposure. Every one of those events is unaffected by Berkshire Hathaway's cash position. They are scheduled, they are advancing, they are the structural setup that the macro environment cannot dismantle. What the macro environment can do is determine the entry price at which retail holders can position before those catalysts fire. That is the variable currently in motion. And that variable is moving in your favor, even though it does not feel like it on the chart. And what happens next changes everything for anyone watching the signals. The institutional players reading the same macro signals I just walked you through are not selling their XRP positions in response to the data. They are reviewing their accumulation strategies. They are positioning their cash for the deployment window that opens when the correction completes. They are doing the work that retail does not do, because the institutional time horizon is measured in years, not weeks. The retail framework looks at a CPI print and asks, what does this mean for the price next month? The institutional framework looks at the same print and asks, what does this mean for the asset class over the next 24 months? Two different questions, two different answers, two different positioning decisions. The retail holder who positions for the institutional time horizon, who buys through the macro pressure rather than waiting for the macro all clear, is the holder who captures the entry that the institutional players are simultaneously positioning for. Storms expose what the weather hid. The strongest hands buy in the rain. And the patient holder doesn't fear the correction. They recognize it as the entry the market was never supposed to give them twice. Smash that like button if this framing helped you see the current weakness for what it is. Not the end of the thesis, but the setup that the thesis has been waiting for. Drop your dip buy strategy in the comments. Are you dollar cost averaging? Are you waiting for a specific level? Or are you fully positioned and holding through? Let's see what this community is doing during this exact window. Subscribe and hit the bell, because when CPI data drops, when Kevin Wash's next signal lands, when Berkshire's next quarterly filing reveals their deployment activity, and when the Senate floor vote on the Clarity Act is scheduled, my breakdown drops within hours of each event. The macro pressure is real. The thesis is intact. The entry is being delivered. Much love. I'll see you in the next one.